Thanks for having me. It's a very interesting development that we are seeing. The Chinese have completely grind their imports to a halt in August. We expect also very low imports of U.S. crude oil into China next month.
Trade war tensions with China certainly hitting the oil patch. On this report that a large independent Chinese refiner canceled U.S. crude purchases.
In early 2025, the world's largest oil market slammed the door on America, cutting U.S. crude shipments from over 160,000 barrels a day to almost zero in just months. China didn't just stop buying, it rewired its entire system around Russia, Saudi Arabia, and Iran, leaving American oil stranded. And the real shock? This collapse was triggered by Trump's own tariff war, and now the U.S. is reeling. In February 2025, Beijing delivered a heavy blow by putting a 10% tariff on American crude oil and a 15% tariff on U.S. LNG and coal. Within days, China refiners stopped signing new contracts, even refusing American barrels sold at discounts. Customs data revealed the sharp fall, from around 160,000 barrels each day in January to almost nothing by May. Tankers that once sailed to Chinese ports were rerouted or left idle. Industry analysts warned this was not a pause, but the dismantling of a trade link that had taken years to build. Export terminals in Texas and Louisiana, designed mainly for Chinese buyers, suddenly faced silence. The 90-day tariff truce announced in May failed to bring shipments back, proving the shift was deeper than price. American exporters now stood outside the world's largest oil market, watching contracts vanish one by one. The U.S. was no longer just losing sales, it was losing relevance. Energy economists compared it to a supply chain being cut with surgical precision. China had made its choice, and the choice was clear. It would no longer depend on American barrels. As American barrels disappeared, China quickly built a new oil map that left no space for the U.S. Discounted Russian crude surged to record levels, carried by shadow fleets that moved quietly across oceans. Saudi Arabia and the UAE locked in long-term supply contracts, giving Beijing stable flows and predictable prices. Iran also gained ground, with shipments climbing to almost 1.8 million barrels a day by June 2025. Many of these cargoes slipped through dark fleet routes, avoiding Western scrutiny. By mid-year, more than 70% of China's crude imports were already paid for in non-dollar currencies, mainly the yuan. This was not a temporary workaround, but a deliberate system built for resilience. China's refineries ran harder than ever, processing 15.2 million barrels a day, the highest since 2023. The country even produced 4 months of surplus oil, giving it the power to store or export freely. Every contract, every pipeline, and every payment method was redesigned to cut out the U.S. with precision. Analysts described it as a structural exclusion, not just a trade shift. America wasn't replaced in crisis, it was smoothly written out of the script. And now, China's oil compass points firmly toward partners who share its financial and political vision. China's oil strategy in 2025 was not only about shifting barrels, but also about shifting money. Long-term supply contracts with Russia, Saudi Arabia, Iran, and the UAE were now signed in yuan instead of dollars. Reports showed that non-dollar settlements in China's energy trade jumped by more than 45% in the first half of the year. For Beijing, this was about reducing risks tied to U.S. sanctions and building financial independence. Analysts explained that every contract in yuan pulled global trade further away from dollar control. Insurance, shipping payments, and even refinery blend adjustments were restructured to work in yuan. American crude, once competitive, now became incompatible with these systems. Even with discounts, U.S. oil could not re-enter a supply chain designed to block it. Economists describe this move as a dismantling dollar dominance, barrel by barrel. By mid-2025, the petro-yuan had grown from an experiment to a real financial weapon. Washington's leverage in global pricing was slipping, and for the first time in decades, the U.S. dollar was not the automatic ruler of oil trade. This was more than trade diversification, it was a currency coup that hit directly at the heart of America's power. For years, the U.S. poured billions into pipelines, export terminals, and shipping routes designed to feed China's booming oil demand. Ports like Ingleside in Texas and Loop in Louisiana were built with Asia in mind, expecting endless Chinese contracts. But in mid-2025, those same facilities were running far below capacity as Chinese buyers vanished. Tankers sat idle, storage tanks filled slowly, and pipelines carried less oil. The American export model had been welded to China, and without Beijing's demand, it now looked broken. Attempts to push crude into Europe, India, or Latin America brought little relief, since those markets are smaller and far more competitive. Margins thinned, contracts were short, and buyers had plenty of other suppliers. Energy analysts warned of stranded assets and shrinking returns on decades of investment. One compared it to a race car stuck in neutral, built for speed but unable to move. The U.S. now faced the painful reality of overbuilt infrastructure and underused capacity. Unless new buyers appear or policies change, much of this network could stay half empty. America's grand energy export dream, once tied to China, was suddenly left without a track to run on. When U.S. and Chinese negotiators met in Stockholm in mid-2025, energy wasn't even on the agenda. Washington tried to pressure Beijing by warning of 100% tariffs on countries that bought sanctioned Russian or Iranian oil, but China stood firm. A brief tariff rollback to 10% gave American exporters little hope, as Chinese refiners had already secured stable contracts elsewhere. Instead of reopening the door, Beijing signed more long-term yuan deals and expanded its crude stockpiles. By June, China had built a surplus of 1.42 million barrels per day, all from non-U.S. suppliers. Analysts said this cushion gave Beijing freedom to ride out global shocks while ignoring U.S. pressure. The U.S. found itself talking tough, but China kept tightening its system around yuan payments and diversified oil sources. Diplomacy looked stuck, with Washington threatening and Beijing refusing to bend. China's message was simple: energy sovereignty was non-negotiable, and with reserves rising and contracts locked, the world's top oil buyer no longer needed to listen to America's demands. While the U.S. struggled to find buyers for its oil, China was already moving beyond it. By mid-2025, new energy vehicles, EVs and PHEVs, made up over 50% of all new car sales in China, signaling a clear shift away from gasoline. Over 14 million charging stations were installed across highways and cities, making it easier for drivers to switch. This rapid expansion cut future demand for imported crude, making oil less central to China's growth. Energy experts noted that every electric car on the road removed years of fuel sales that once went to American exporters. For China, the EV boom was both an environmental policy and a geopolitical shield, reducing reliance on foreign energy supplies. The more EVs sold, the weaker the grip of U.S. oil on global markets. Automakers like BYD rolled out affordable models, making electric cars accessible to millions. Government incentives and strong consumer demand pushed adoption even faster. By mid-2025, China wasn't just the largest oil buyer, it was also the largest EV market in the world. Analysts warned that this structural shift would permanently shape global energy demand. For Washington, it meant that even if China reopened to U.S. barrels, the market would never be as big as before. The collapse of U.S. oil sales to China was not just about tariffs or temporary politics, it was a full structural break. China rebuilt its energy system so that every part, from shipping lanes to payment methods, no longer needed the United States. What replaced American crude was not only cheaper oil from Russia, Saudi Arabia, and Iran, but a new web of contracts designed to last years. By 2025, more than 2/3 of China's crude imports were settled in yuan or other non-dollar currencies. Chinese refineries, pipelines, and reserves were all adjusted to handle non-U.S. suppliers with ease. Analysts called it a permanent energy divorce, where the two largest economies no longer shared a vital link. Even if Washington eased tariffs, the system was already locked against them. Meanwhile, China's EV push reduced its long-term dependence on fossil fuels altogether, making future U.S. oil even less attractive. What was once a strong trade bridge had turned into a wall. For America, the loss went deeper than sales. It was the loss of influence in the world's largest energy market. And for China, it marked a milestone in building true independence from U.S. power. China has permanently redesigned its energy future without America, and U.S. oil is now left on the sidelines. Subscribe for more sharp insights on global power shifts and share your thoughts. Has Washington already lost this race?